this video, I want to share with you the one indicator that changed my trading forever. If I had to start over with just one trading indicator, this would be it. Early in my trading journey, I made the same mistake as everyone else. I cluttered my charts with too many indicators, trying to chase the perfect setup. But the more I tested and the more I traded strategies, the more I realized that simplicity wins. And if there's one indicator I could never trade without, it's the moving average. This is the foundation of my zip trading strategy, the one system I've relied on more than anything else for the past 10 years. It's also the one strategy that has not seen a losing month since May of 2023. And today, I'm breaking it all down for you so you can simplify your trading, filter out the noise, and focus on what actually works. But first, let's talk about why moving averages are the ultimate trading tool in my opinion. The only trading indicator I think you'll ever need. Moving averages aren't just lines on a chart. They are so much more than that. They're trend indicators, price action filters, and even dynamic support and resistance levels, all in one. So whether you're scalping, day trading, or swing trading, and even if you're going for the really big positions, understanding moving averages can help you time your trades with precision, confirm whether the trend is in your favor before jumping in, and avoid weak setups or fake outs. Depending upon the length of the moving average and the type you're using, they serve different purposes. So let's break down which moving averages I like to use, when to use them, and how they're all different. I want to start with the 5 SMA, Simple Moving Average. I have this on the charts that I look at every single day. It's the shortest moving average I'll use. What I love about the 5 SMA is that it's a short-term momentum guide. It reacts very quickly to price changes. It can be quite volatile, but makes it perfect for identifying short bursts of momentum and makes sure that you're on the short side of short-term momentum. As a rule of thumb, if the price stays above the 5 SMA, the bulls are firmly in control in the short term. If it drops below, there's more indecision, and the bears may be taking charge. And this is true of all the time frames you put it on. This moving average is a favorite among scalpers and day traders who are looking for quick price action and quick movements in their favor. I personally like to use the 5 SMA as short-term resistance and support. I also like to look at the 5 SMA and the 20 SMA crossover for a more significant trend change in momentum. Let's take a quick look at this on the charts. Now let's start by adding the simple moving average into your chart. So click on indicators, type in SMA, and you will get the simple moving average, which is right under technicals. So when you have the simple moving average, it'll probably default to Tradingview's default, which is 9 SMA. To change the time frame, click on the little gear icon, and let's start with the 5 SMA. So as I said, the 5 SMA is a great measure of short-term changes in momentum. And one of the charts that you can use it on is the 15-minute chart. So this is a 15-minute chart of the euro, and what you will see is that it is a very important support and resistance level, and perhaps a short-term momentum change. Because if you look at the 5 SMA, you can see that in this whole period here, and these are 5-minute candles, it's 5, 10, 15, 20, 25, 30, the 5, 40 minutes. The euro dollar is holding above the 5 SMA for the whole time. And when it drops below it, it does, we only have one candle, but it'll probably continue. It'll probably be something like this. Whereas in this example here, you can see in the euro dollar, when it has fallen below the 5 SMA, it remains below it for 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60 for basically an hour and 10 minutes. And in this whole time, you could be, first of all, it'll tell you that the short-term trend is bearish. You could be selling at the 5 SMA until it closes above the 5 SMA. And the point at which it closes above the 5 SMA is when we get a short-term trend change. And you see that much more dramatically over here, where previously over here, we're above the 5 SMA the whole period. We finally close below it, and it represents a short-term trend change, a meaningful one. It'll last for a couple of hours, but it's a great way to take a look at how things are moving on a short-term basis, and really good to take a look at on a 15-minute chart. Now, the 10-day SMA or 10-period SMA is also popular as a checkpoint for short-term price swings. It smooths out some of the noise that you'll see on a 5 SMA while still reacting relatively quickly. If the price crosses above the 10 SMA, for example, it's a sign that the short-term uptrend is forming. A break below could mean a pullback is underway. Swing traders oftentimes will use this to confirm their entry and exit points. And I want to show you how to look at this on a chart. Now let's change this to a 10 SMA. And a 10 SMA is smoother than the 5 SMA. And it also can give you quite a bit of information on trend, support and resistance, and trend changes. And it is a smoother moving average. So it tends to react less quickly. But a break below it, for example, could mean that there is a more significant trend change. Now, I would use the 10 SMA on a slightly longer term chart like the 4-hour chart, because you can see on the 4-hour chart, when we are in a nice downtrend, the euro dollar remains below the 10 SMA. And when we have a trend shift, it remains above it, and that every retrace is holding it as support. So for example, if it's a great moving average to use as a trailing stop. So if you are, for example, in this long euro dollar trade, what you could do is you can wait for a close below the SMA as a point to get in. And this is a nice representation of how you could trail your stop potentially. And here's another, great example of how you could trail your stop. Like, let's say you're short this whole time. I would stay in the trade until it closes above the 10 SMA. And that would be a really nice trend change signal that could also be a way to trail your stop. Now, I personally prefer the 20 SMA. It's my secret weapon for spotting pullbacks and trend shifts. It's smoother than the 10 period SMA, which gives me more confidence that a trend change is legitimate. If the price closes above and holds the 20 period SMA, it can be an early signal of a strong uptrend. At the same time, this level also serves as a high probability buy zone when price actually pulls back and finds support at the 20 SMA. Think of it like a trampoline. If the uptrend is strong, the price will bounce off it. But if it breaks and closes below the 20 SMA, it could signal a deeper correction ahead, and one that could last for some time. Let's take a look at how this looks like on the charts. While the 5 SMA is a great measure of short-term momentum, and the 10 SMA is a really great indicator to use to trail your stops, the 20 SMA is actually one of my favorites for true trend changes, because the 10 SMA could be a little bit more volatile. And I'll tell you what I'm talking about by adding the 20 SMA, and I'm going to put back on the 10 SMA to show you the difference between these two. So I'm going to put on the 10. I'm going to change this to a different color. So move this to 10 SMA. Let's make this red so it's easier for everyone to see. So as you can see, there could be more volatility, in and out the 10 SMA, like you see here in the euro dollar, like you see here. It actually happens a lot, even over here, you can see a lot of movements, where we don't quite have the real trend change yet, but, drop below the 10 SMA, which can give you a lot of false signals. The 20 SMA gives us a lot more real signals and true signals of trend changes across multiple time frames, across the daily chart, the 4-hour chart, the 1-hour chart. It's really something I like to use a lot. I like to use it mostly on the 4-hour chart and the 1-hour chart because they encompass really nice trend changes like you see here in the euro dollar, and that you can actually trade it. Basically, you can trade the break below, the close below the moving average, and more often than not, you will get a more significant trend change. But 4-hour charts are pretty lengthy, so I do like to use it on the 1-hour chart as well, and I also like to use it as a support and resistance level. So I use it as a support and resistance level, but I use it most commonly as a trend change, meaning that, for example, in this chart, if we broke above the euro dollar, and I see that it tried to pull back, and it's held the 20 SMA, then that's a very strong signal to me that, we perhaps get a more significant uptrend and that support and resistance level is held. The 50 SMA is a key level that's actually used by institutional and professional traders alike, especially swing traders. It serves as a very important trend confirmation level. If the price stays above the 50 SMA, it means that the uptrend is holding strong. A break below the 50 SMA or 50 period SMA for that matter can indicate potential trend weakness. You want to watch this level during pullbacks. It's oftentimes where major reversals occur. Now let's add on the 100 SMA. So the 100 SMA is a major support and resistance levels. The difference between the 50 SMA and the 100 SMA is the 50 SMA is very often tradable as a long-term shift in trend. The 100 SMA, as you can imagine, it's based upon the last 100 prices, which on a daily chart is a very long time. It's not as useful, in my opinion, for regular trading. Yes, it can signal a big move like it has here and here, but it's very late to the move. But it is also a very significant support and resistance level, because you can see here in Eurodollar, it's tried to be near the 100 SMA, but failed to break above it. And when we finally get, like even over here, it tries to close below the 100 SMA, but it fails to do so. And only when we get a close below the 50 SMA has become a more significant trend change. And then it can be a very powerful resistance level for getting back into the trend. And you see that here, you see that over here after we broke out here, it retraced and it got back in. Here, it's held the 100 SMA quite some time. Here, it broke down below the 100 SMA, came back, held it once again. So it is, the best way to use the 100 SMA is as a support and resistance level. The 200 SMA is the line in the sand, the ultimate line in the sand between bulls and bears. If the price stays above the 200 moving average, it's considered a long-term uptrend. If it falls below it, that's often the first sign of a major bear market. So you want to watch that very closely. Many big money investors use this level to decide whether to buy, sell, or wait. Now, I personally use the 200-day estimate, 200 period estimate as support and resistance, as it's too long-term for the trends I trade, but I do watch it closely. The 200 SMA is the line in the sand between bulls and bears. So I have the 200 SMA in the chart. It's a very, very long term. And actually, a lot of importers, exporters, fund managers may just use the 200 SMA as the true indication that their idea is wrong. And we see this actually quite often in the equity market, where if we finally broke below, just as we've seen here, the 200 SMA, then we're truly in a bear market. And that's, what you're seeing in this chart right now. And you can see here, it was trying to hold. It went up, it went down. There's a bit of a head and shoulders pattern around here with left shoulder, right shoulder. Finally broke down, and we had a much more significant fast move lower over here. And when you finally broke above the 200 SMA on a more significant basis, that could really mean a shift in trend. This I use more, as I said, if it's around the levels I'm trading for support and resistance, but it's probably the one that I use the least. My favorite, hands down, in terms of the moving averages, will have to be the 20, 50, and the 100 moving averages. As you can see, moving averages can be extremely useful in trading, helping you ride trends, spot reversals, and time your entries like a pro. Whether you're chasing quick momentum with a 5-period SMA or using the 100-day SMA as a trend barometer, each of these moving averages can help you filter out the noise, spot trends, and manage risk. And that's exactly why they're the core of my zip trading strategy. Not only are they key inputs and part of the calculation and the design, but I also look for moving average clears to confirm my trades. So no matter the market, the time frame, or conditions that you're looking at, they work. If you want to learn more about how to use moving averages, you want to learn more about my zip strategy, please join my free community. The link is in the description below. And please subscribe to my channel. It helps to keep me motivated to create more valuable content like this for you. And let me know in the comments what your favorite moving average you like to use, if you use it at all. And I will see you all in the next video.